we're in tough times. It's important that the market out there gets to know what are the key items we can pick from these torrid times that we're going through, especially in the world of the financial markets. What is there for you as an investor? What's there for you as an enterprise in these tough times? Of course, we have some banking institutions that have recorded record high results amidst all the challenges. We have those that are definitely struggling, but there are a couple of factors that inform these results. One, we have for the first time realized that some commercial banks have resistance to the pressures and to the shocks. Basically because of the few practices they have internally, a few governance structures, a few management initiatives that they have taken. But for now, I want us to ask ourselves, in a time where literally no one was banking, in a time where everyone was under lock, what was there to do with a commercial bank? Okay? How do you diversify during those times? Now we know that we might have a third wave, a fourth wave, a fifth wave. And this is a virus. We're not certain of the future. So what practices have driven for those that have had an uptick in the revenues? If you look at the numbers, if you look at the results that we have seen so far, the provisional results at half year, what you're seeing are entities that invested in fixed income. Commercial banks that went in for bonds, for treasury bills, that switched their goal plan to investing in risk-free assets. You realize that they have yielded very good results. You realize that they hardly feel the pressure of these COVID lockdowns that we've gone through. Now, there are those that are focused on purely non-funded income. Okay? They are focused on client transactions. They have pushed clients to transact electronically. They have pushed clients to use services, online banking, the banking apps. Now, the little fees that seem little have paid off finally. Why? When everyone was at home, the only way they could access banks was using the online platforms. Now, for every transaction that happened at that point, banks were collecting a small item. Okay? Of course, when you look at the aggregate, it's why you're seeing the revenues picking up for such commercial banks. There's a small commission that the banking institutions get to benefit from selling insurance. Remember, this is non-funded. The bank has not put out any capital to offer bank assurance service. They're just earning a commission as a financial institution. So these revenues that every other financial institution was ignoring are starting to be paramount in your day-to-day running of the business. Look at how much insurance had to be picked, especially medical, during these tough times. How much commissions have been collected by the banking sector? Those are the results we're seeing with the financials. Now, we have a challenge. There are those that have seen a drop in the revenues. What could have been the cause? Again, it's purely impairment. Now, Charles, impairment management doesn't have cast in stone. Based on the portfolio you have, the book could behave in a certain way across the continent. So what are you seeing? The entities that took a while to respond in terms of managing portfolio were hit hard by impairment. So the write-offs have literally washed away the bottom line for most of the financial institutions. And we're continuing to see more write-offs. Why? Very many enterprises have closed. Very many clients have lost contracts. The expatriate community has literally stopped transacting. You're not seeing any foreign direct investments. So at the end, the local enterprise that we have with the grassroots has not had any access to cash. So what happens? They cannot pay their facility in the bank. So naturally, the end result is a bank has to write off. Now, write off means the entire loan that we had, that you owed us as a client, we have to write it off. It hits our income statement. Now, for all the hard work that has been put in for the previous period, the fact that you have a bad loan, you have to lose that money. Now, the next thing that we feel that could have caused the drop is the drop in appetite for loans. Generally, most customers have dropped appetite. There's no reason to borrow. There's no enterprise to invest in. There's no opportunity to jump on. So there's no need for loans. Now, for institutions that have been relying on interest income, we are seeing a huge drop in their revenues. Okay? No one is willing to borrow because they don't have anyone to take the money. So the next options are keep their cash in their houses, okay? Or stay with the little that you have. Now, if as a bank, your reliance was purely on interest income, that's the hiccup that you're seeing right now. There's a drop in deposits. Now, Charles, banking institution, deposits are their blood, okay? It's a cash conversion cycle. It's for them, until a bank has deposits, they won't be able to trade, literally. Why? When customers don't bring deposits to the bank, a lot happens. It means financial institutions won't be able to participate in the interbank. It means financial institutions won't be able to participate in the fixed income market. It means they have no blood, for lack of a better word. Now, the less deposits we have seen in this period, for about 1.5 years or 2 years, we call it, the less income some banks have recorded. Now, we take this for granted. You've had scenarios before where we've had a run on the bank. We call it a run on the bank, where one small hiccup causes clients to withdraw their cash from the banks. When you withdraw your cash from the bank, it means you're depriving it of its blood. So banks that have hardly had any deposits during this time, especially those that don't have alternate channels to attract the deposits. They don't have the point of sale machines. They don't have cash collection centers. They don't have bulk collectors. It means they have hardly had access to any deposits. And deposits are the most free cash you'll ever get. Because most cash, especially for banks, they look out for the cheap deposits. If you bring me a fixed deposit and I have to pay you interest on it, you might as well just take it, okay? We prefer a client who has brought their cash and it's free and they're just trying to save it in the bank. Then the bank will go ahead and use that cash and multiply. If a bank is required, if the shareholders of a bank are required to increase their core capital, what does it mean? There are so many things we're going to see in the market in the next few months. That's my proposal. Sorry, that's my projection. We could see a merger happening because shareholders may not naturally have the cash seated there to increase the core capital. That's number one. Two, we could see an acquisition. Most likely, the smaller banks or the less capitalized banks might be washed out of the market. Why? So either you mark it up or you step out. So the options they have are to run around the globe, raise capital, and reinvest into the business. Alternatively, they could think of a merger. Now, for the consumer, is there an opportunity for us? Yes, there's an opportunity for us. The higher the core capital of a bank, the higher the single obligor limit for them. So if you have so many banks whose single obligor limit is very small, it ties down those who want to acquire big loans from the commercial banks. So for us as the consumers, there's an opportunity in this. Think about it. You're going to have more bigger banks whose appetite for debt is going to be a little higher, whose ability to dispense large loans is going to be possible. So possibly it could save us from the hassle we've been going through to pick cash from abroad and invest it here from bigger banks abroad. So if we create 10 bigger banks, you're better off than having 30 small banks who cannot take care of the needs of a typical investor in Uganda. We can't sit comfortable where the world is moving so fast. Globally, commercial banks have diversified on how they do business. The mortgage business has picked up in the Western world. The card business has picked up. So either we see this as an opportunity and think of a merger, or withdraw and lose out on the big opportunity that comes with this. We have oil coming up. The requirements for investment in the oil sector are definitely going to be very high. So either the local banks form some kind of conglomerate or think of a merger and naturally quadruple or increase their core capital thresholds and benefit from the oil sector that's going to be really sprawling in the next few months, or they miss out. So for me, I think let's look at the positives in this. There's definitely a reason the central bank has taken this direction, but it's about us pushing ourselves to the next level to make sure we can take care of investor requirements.